$500. That's it. Not $5,000, not $50,000, just $500 a month. So today, we're breaking down exactly how to invest $500 per month the smart way and how this simple strategy could help you retire years earlier than most people. If invested consistently, $500 per month can turn into more than $1 million over time, sometimes far more. Step 1. Understand the power of compounding. Before we talk about investing strategies, we need to understand the real engine behind wealth. Compound interest. Compound interest means your money earns returns, and those returns start earning returns too. Over time, that creates a snowball effect. For example, if someone invests $500 every month with an average 10% annual return, after 40 years they could end up with over $3 million. And here's the crazy part. They only invested $240,000 of their own money. The remaining millions come purely from compound growth. This is why investing early is so powerful. Because in investing, time matters more than income. The earlier we start, the more time our money has to multiply. Step 2. Automate your investments. One of the biggest reasons people fail at investing is simple. They rely on motivation. Motivation fades. Automation works forever. The smartest investors treat investing like a bill. Every month. No excuses. No delays. The moment your paycheck arrives, $500 automatically moves into investments. This strategy is called dollar cost averaging. Instead of trying to time the market, you invest regularly regardless of whether markets are up or down. Over decades, this method reduces risk and builds wealth steadily. And perhaps most importantly, it removes emotions from investing. Because the truth is, most investors lose money not because the strategy is wrong, but because their emotions get in the way. Automation protects you from panic selling during market crashes. It also prevents the opposite mistake, buying too much during hype and market bubbles. When investments happen automatically, consistency replaces hesitation. Over time, that consistency becomes one of the biggest advantages any investor can have. You're not trying to outsmart the market anymore. You're simply letting time and discipline do the heavy lifting. Step 3. Invest in low-cost index funds. Now the big question. Where should that $500 actually go? Many beginners try to pick individual stocks. They chase hype. They follow social media tips. But history shows something surprising. Most professional investors fail to beat the market consistently. That's why many experts recommend low-cost index funds. These funds simply track the entire market. Examples include funds that follow the S&P 500. Over long periods, the U.S. stock market has historically averaged around 10% annual returns. That means instead of gambling on one company, you're investing in hundreds of companies at once. Your money spreads across technology, healthcare, finance, energy, and many other industries. So even if one company struggles, others can continue growing. This built-in diversification reduces risk for beginner investors. And because index funds are passive, their fees are usually extremely low. Lower fees mean more of your money stays invested in compounding over time. Over years and decades, that simple advantage can make a huge difference. It's simple, it's diversified, and historically, it has been incredibly effective. Step 4. Reinvest every dividend. Here's a secret many new investors overlook. Dividends. Many companies pay dividend small cash payments to shareholders. If you spend those payments, your growth slows down. But if you reinvest them, the compounding accelerates dramatically. This is often done through something called a dividend reinvestment plan, or DRIP. Every dividend automatically buys more shares. Those shares generate more dividends, which buy more shares again. This simple cycle turns small payouts into a powerful compounding engine. Instead of your dividends sitting as idle cash, they immediately go back to work in the market. Even fractional shares can be purchased, meaning every dollar stays invested. Over time, your share count slowly grows without adding extra money. And those additional shares generate their own dividends. In long-term examples, investors who reinvest dividends can end up with dramatically higher portfolio values compared to those who take the cash. And over decades, this cycle becomes a powerful wealth machine. Step 5. Increase your contributions slowly. $500 a month is a powerful start. But here's the real secret to early retirement: gradual increases. Every time your salary increases, increase your investment contributions too. Even a small bump, say $50 more per month each year, can dramatically accelerate your wealth. Over 30 years, even small increases can add hundreds of thousands of dollars to your portfolio. The key is making these increases painless. Instead of upgrading your lifestyle every time your income grows, upgrade your investments. This strategy also helps avoid something called lifestyle inflation, where higher income simply leads to higher spending. By directing raises and bonuses toward investments first, your future wealth grows automatically. Over time, your contributions become larger without feeling like a sacrifice. And the bigger your portfolio becomes, the faster compounding begins to work in your favor. Small increases today can turn into massive financial freedom decades later. Step 6. Avoid the biggest investor mistakes. Even a perfect strategy can fail if we make emotional decisions. Here are the 3 biggest mistakes investors make. First, panic selling. Markets will crash. It's inevitable. But selling during a crash locks in losses. Historically, markets have always recovered over time. Second, chasing trends. Every few years, a new hot investment appears. Crypto hype, meme stocks, speculative tech companies. But long-term wealth rarely comes from hype. It comes from patience. Third, waiting too long to start. Starting at age 25 versus 35 can literally mean millions of dollars difference by retirement, because time is the most powerful ingredient in compounding. Step 7. Calculate your early retirement timeline. Let's look at a realistic example. Suppose we invest $500 per month. Average return 7%. Time 30 years. At the end of that period, your portfolio could reach roughly $540,000 to $566,000, depending on market performance and compounding assumptions. Remember, you only invested $180,000 of your own money during those 30 years. The rest comes from the market working for you. Increase that timeline to 40 years. And the numbers grow dramatically. With the power of compound growth, long-term investors can potentially see their portfolios reach hundreds of thousands or even millions, especially when dividends are reinvested and contributions stay consistent. This is why starting early is so powerful. Time multiplies every dollar you invest. The goal is building a portfolio large enough that your investments pay for your life. Step 8. The FIRE strategy. There's an entire movement built around this idea. It's called FIRE. Financial independence. Retire early. The concept is simple. Invest aggressively. Control expenses. Let compound growth work. Many FIRE investors invest hundreds of dollars every month into diversified portfolios of index funds, dividend stocks, and real estate investment trusts. Once their investments generate enough income to cover living expenses, work becomes optional. And that freedom is the real goal. Most people believe building wealth requires huge salaries. But the truth is different. Wealth is often built quietly. $500. Month after month. Year after year, slowly turning into hundreds of thousands. And eventually millions. Not because of luck, but because of discipline. The earlier we start, the more powerful the result. And one day, that small monthly investment could buy something priceless. freedom. If you enjoyed this video, make sure to like and subscribe, because on this channel we break down money, investing, and wealth strategies that can change your financial future. And remember, the best time to start investing was 10 years ago. The second best time is today.